Hi, my name is John Vance, president of Vance Wealth, and thank you for joining us for our monthly webinar. Today's webinar focus is going to be on the post-election update. I know your most favorite topic, given that we've probably had plenty of, if you watch any TV, plenty of advertising, plenty of mail coming to the house. So hopefully today I'll be able to wrap up some of the information on what happened in the election, what's likely going to happen kind of in the political landscape, and then also give us a sense of what this means for the next couple of years prior to the next election in 2024. So one of the things I always have to be careful of, especially when you get into conversation around politics, want to keep it as neutral as possible, try to stick to the facts. There definitely will be times where I will share my opinion. I can't help myself. I definitely will, but today's is going to be mainly just an update on what's going on and what we expect that the impact will be on the financial markets primarily. As always, we're doing this webinar live. I can take questions. You can use the chat feature. So all you'd have to do is go ahead and click on chat, type in your question, and then I'll do my best to get to it as we're going through the content today. So let's try to keep it fair. Let's try not to keep it too politically charged because that's not helpful. Especially it's hard on if I'm reading a question versus actually having a real dialogue. So, but I do welcome questions. I think that can add a little bit to some of these areas. The reality is we know all the elections around the country have not all been decided. So there's still some uncertainty. There's actually a couple slides that I have that are a few days old, and we have some more clarity even today that I just couldn't get around to updating. So just wanted to make you aware of that. And so let's just kind of jump in and we'll get into the meat of the conversation today. So as we go through just some topics we're going to discuss is just a high level analysis of the midterm elections. We'll talk a little bit about some of the impact on legislation. We'll also talk about the market impact, historically looking back and seeing what midterm elections mean for the economy, what they mean for the stock market. We'll go through some fun historical data just to shed some light on things that have happened in the past. And then looking ahead, kind of an early preview of the 2024 presidential election. And that's going to be it for our talk today. So let's jump right into some of the results and the key takeaways. So as we go through, and just wanted to actually, before I jump in, most of this content was generated from Raymond James, from their presentation that they put together last Thursday. I did cut it down because it was pretty lengthy. So I took out a lot of slides and I summarized it into the areas that I thought would be the most beneficial today. So if anyone's interested in seeing some more of the slide decks from or the actual presentation, I do believe it's available on raymondjames.com, and you can pull up Larry Adam and get information, be able to watch him live if you want to hear a different perspective as well. So the 5 key takeaways: United States is a split nation. That's not a surprise, but it's pretty remarkable how many of these congressional seats were pretty split 50-50, where these votes were really tight. So we already knew we were a split nation. This just definitely confirmed it, in spite of what I would say the media leading up to the midterms had a sense that there was going to be this Republican wave. It did not occur. And again, it just confirmed that we are a split nation. Number 2, because of the elections and the results of them, or the pending results, we're not likely to see a lot of major legislative changes. So for someone in my perspective that I like to see limited government, the fact that there's going to be no major legislation because of the gridlock that we're going to see is a positive to me. I do think the markets view that as a positive. If anyone's been watching the markets over the last couple of weeks, I think the markets did rally in anticipation of this red wave. The red wave did not occur, and then the markets didn't like that. And then, oh, by the way, we did see the inflation numbers come down. So that's a healthy sign for the economy, because it means the Fed might be able to pause some of their aggressive interest rate movements. And so stay tuned, but you can see there's been a lot of volatility in the markets given some political dynamics. But at the end of the day, most of the market moves are going to be driven on the economy. Number 3, history is correct in the direction, but not in the magnitude. So it's pretty common when you have one party, Democrat or Republican, that has the majority in all three areas, right? Presidency, the House, and the Senate, that when you get to the midterms, tends to flip over and have some sort of a mixed government, because I think generally, I don't know if popularity tends to wane, but when you have one party in control, there's a lot of change. And then I think that gets the independent vote out, where they make some decisions around, you know what, we don't really like some of these changes, so we're going to vote for the other party this time. And so you tend to get this balance of power where you don't have this majority. So that happened again. It looks like to us that the House of Representatives will be maintained, or actually picked up by the Republicans. And so the history shows that this is the pattern that occurs. Again, the direction was correct, not the magnitude. The number of seats that were expected to pick up by the Republicans was a lot larger than actually that came to fruition. So that's number three. Number four, broad concerns drove voters. So at the end of the day, when you started to look through the data of what really was important, I guess it depends on who you asked. But the big drivers that we were seeing that was polling early on was the economy, which was all in part inflation. And then we had, that was one side, which is one of the reasons why Joe Biden's approval rating is quite low, because of the concerns about the economy and inflation. And then the other big driver, which really drove the Democratic side of things, was the Roe v. Wade and women's reproductive right issues. And that really drove, it really drove young single women especially. And so if you looked at all the data that came out, I'm not going to share all those percentages because that data is not fully accurate just yet. But those were the big issues that drove voters out from both sides. And so, but again, it was the broad concerns about where the country is going. And so that's why we, again, see that we're a split nation and we had a pretty divided outcome. And then relative winners or losers. And I'll get into that a little bit, but you definitely saw in some states like Florida, where the Republican Party really ran away with it, with DeSantis winning a pretty convincing victory. And then a lot of the Senate rates and even a lot of the House rates that people were expecting to go Republican did not. And a lot of it has now turned out to see those that were supported heavily by Trump were the ones that had a much tougher time. And so that tells us a lot about where the Republican Party is going to go. So when we get towards the end of the conversation today, there's some data out already on who's kind of favored to run, who's favored to win going into the 2024. I do recognize that I believe probably in the next few hours, we're going to hear whether Trump is going to run for presidency again. And I guess I'll touch on that as we get towards the end. I don't think I'm going to have this. Some of you might get the update while I'm holding this because we are in the afternoon. So if anyone gets any information that's accurate, send it my way so that I can potentially touch on that. Okay, so we're going to start going through a sense of some data slides here. And most of these are going to be pretty easy for me to explain. There might be some things that get a little bit into the weeds, but we don't cover this very often. Midterm elections obviously only happen every 4 years. Primary elections happen every 4 years. So just wanted to share some data. So one of the things that's been pretty, pretty normal going back to 1980 is that unified control of the government, meaning by one party, has only happened 27% of the time. So it is rare that we have unified government. We usually have divided government. And I think most people prefer a divided government so that there's checks and balances, right? The other thing is it's also been very rare that the party that's in control keeps control. So again, we're coming off of 2 years where the Democrats had controlled the House, the Senate, and the presidency. And so now we're seeing that the House is likely going to go Republican. So we're back to this divided government. And so what this then shows on this chart is going back to 1945, the periods of time when it's really bold, either in blue or in red, is when the party, one party had full control. As you can see, since 1980, it's been pretty rare and it doesn't last a long period of time. And so that's one of the things that's normal, that's to be expected, and that's what we're dealing with through this election. So this chart says the Senate is still a toss-up. It looks to us now that, and you look in the bottom right-hand corner, there's these two yellow seats, which is Arizona and Nevada, yet to be called. I believe those have been officially called as of the last day or so. So it looks to us that even if there's going to be a runoff in Georgia, we thought that initially was going to probably drive the decision on the Senate, but it looks to us like Democrats will stay in the majority of at least 50 seats. And with the tiebreaker being Kamala Harris, if the Georgia runoff results in Herschel Walker actually winning to make it a 50-50 tie. So it seems like the Senate is not a toss-up, that it's going to be controlled by Democrats. There's some policy ramifications of that occurring, and I will touch on that a little bit today as well. So the House, as of the time of a lot of this data coming out, which was last Thursday, it looked to us like the Republicans were going to win a larger majority. They only need 218 seats. So projecting about 222, 223, somewhere in that range. It looks like that's going to be even a more narrow victory, but still Republicans in control, which means likely a new Speaker of the House. I don't see a scenario where that wouldn't occur, but who knows? Funny things can happen in politics. And so again, from my perspective, I like the division. I like that politicians will have to work together. Now, the reality is what we have seen, especially over the last 12 to 16 years, we just haven't seen a lot of working together across the aisle. And hopefully that will change. It's really out of our control as Americans, unfortunately. But hopefully our politicians will work together on any major legislation that does have to occur, and be smart and work across the aisle to make decisions for Americans that are going to improve our nation, not only in the short term, but long term. But the reality is it's not going to just be one party that's driving all the decision making, which again, from my perspective, is more of an independent. I like that. So the other thing, that there was a lot of governors races that were up, and Democrats picked up more governors. And so it's still about a split around the country, with the Democrats picking up a few more governor seats during the midterm. Okay, so let's get into a little bit around, okay, so what's the impact on legislation and what can get done, right? Because the reality is government's got to get back to work. They got to make some decisions. So let's talk a little bit about political potential outcomes. What are some of the things that we're going to see? So because we have a divided government, we're not likely to see major policy shifts. It'll likely just be more of the same. And again, because of the gridlock, not a lot of changes. The next one, which I think for most investors and most of you that are decent earners and higher earners especially, no changes in tax policy. So tax policy is likely going to stay intact for at least another 2 years. We are coming up, if any of you sat in a meeting with me, and we've talked about what are known as the Trump tax cuts. Those are set to sunset in 2025 and revert back to these old tax rates in 2026. But it's only 2022, so we do still have some time. But it looks like tax policy for 22, 23, and 24 will likely remain the same. Maybe some small tweaks if you can get bipartisan support, but tax policy is going to remain intact. Now, whether you like that or not, the thing that I like about it is that we can do planning effectively because we have a little bit more clarity. One of the hardest things from an advisor perspective is when we're on let's say as we went into year end and we were on the brink of some tax changes, if we didn't know what they were going to be and the government changes them at the last minute, oftentimes in mid to late December, that makes planning really difficult because we have to deal with this on a client level and everyone's individual, but we also don't know how they're going to tilt. And so making planning decisions can be quite difficult. And so I'm pretty pleased that we're not likely going to see any major tax policy changes, which allows us to continue to maintain the discipline of looking at current tax rates at pretty low levels and helping clients make good strategic decisions around tax planning and things like Roth conversions and the things that we've talked about on many of these webinars throughout the year. The third item on here is, we're looking at elevated risk for a shutdown. This is a little bit of a comedy because this happens all the time. The government has to set this debt ceiling, this amount of debt that they're willing to go towards, and we always bust through it. We're always spending too much. And so there's always this threat of whoever's in power, I guess whoever's not in power is threatening to shut the government down. And so we're going to go through this again, unfortunately. Again, I say it's comedy, it's sad, but it's the reality of what we're having is we can't make some decisions around, okay, let's control some of our spending, let's be a little bit smarter, and let's work together to make some good pragmatic decisions. So this is just going to be another way for the politicians to fight. And, you're going to see this talk of shutdown, and which it does roil the markets. The markets don't like it. It generally in the past when this has happened has meant some shorter term volatility. So that might occur. It doesn't have any long lasting permanent impacts, but it is disruptive in the short term. So that's kind of the third item on here. Increased focus on industrial policy. Basically you've already seen a lot of that happening on trying to kind of reshore a lot of our manufacturing and how we're producing things. And there's been a lot of focus on energy policy around that, on electric vehicle policy, and how each state is dealing with that. There's obviously a lot of political tensions that's happening in China with Taiwan, and the fact that so many semiconductors come out of Taiwan, and the fact that we are heavily reliant on needing semiconductors for basically all walks of business, and all lines of business. And so there's going to be a big increased focus on industrial production and industrial policy, and hopefully that's an area where politicians can come together. And you know what, they're going to have to negotiate because at the end of the day, we've talked about being in a mild recession. The data is still kind of mixed. It's kind of like we went into a recession. Are we coming back out? But it's just going to be a slow, kind of sluggish economic environment for, we'll see anywhere from, let's say, 6 months to another maybe 12 months. And the reality is the best way to get us out of this is to have a strong economy and a strong policy going forward on bringing jobs back or creating new jobs. So there's definitely going to be a focus on that. We can cross our fingers that we're going to get politicians to actually work together and make some good decisions for us. And then there's going to be increased pressure on China and Russia. Clearly, these are issues that Americans have to deal with. The policies coming out of these two big superpowers and their impact on the rest of the world. That's not going away, unfortunately. And a lot of the things we're seeing is starting to bring some more manufacturing back here. Obviously puts the US in a better environment or in a better position on a go-forward basis, but this takes time. That's one of the challenges with the political dynamic that we live in, and that I hate to say it this way because I'm, you know me, I'm an optimist. I like to look at things in a positive way, but unfortunately our political landscape, we're dealing with the House that's every 2 years, right? So you're just constantly running for, based on the policy, and obviously the presidency is 4 years. But, we have a 10-year plan here. I actually have a 20-year plan for our business. But, we work on longer term plans, and it always feels like our government is dealing with such short-term issues. And the reality is because of how our election system works, and everyone's very short-term focused. And so hopefully we'll be able to get some better focus on long-term planning to solve some of the real challenges we have here. And, coming out of an election cycle, I think the negativity is up at these higher and higher levels. I do think the future of America is very bright. You can't really convince me otherwise. We find a way to, be competitive and to innovate and continue to get better. And I do think that's going to continue to occur. I think really in spite of the government. So government kind of gets in the way, in my opinion. And in spite of the government, we're able to continue to persevere. Still going to be a choppy environment. What the Federal Reserve's having to do right now to combat inflation is definitely putting a lid on the economy. But it was necessary. When you get pricing of real estate, pricing of the stock market, pricing of things like cryptocurrency that were just going up too far, too long, too high, in my opinion, for too long, you have to start bringing that back in, because stable prices are very important for our economy, and you don't want to have these boom bust periods. And so what's happening is necessary, but it is going to be painful. So that's why we've been forecasting a mild recession, but maybe a longer recession. So let's get into a couple of the big issues. So I know I just highlighted on some of those. This is where the fun numbers, I don't think I'm going to spend much time on this, but the embarrassing fact of looking at this chart on the left is the fact that we had, debt in 1996 for our country, which is just around $5 trillion, and now we're above $30 trillion. I mean, look at that chart. It's pretty ridiculous when you see the amount of spending that's occurred. The reality of this chart is on the right-hand side. It says shutdowns have not impacted performance. I did say that on a short-term basis, there definitely can be some like on a 1 month basis, there's definitely more volatility. When you look at it over 12 months, though, historically, markets have been good even after a shutdown. So I wouldn't use this as it would be a good buying opportunity if we get some volatility because of a shutdown, but not looking at it as a scare tactic to say, okay, I need to abandon my long-term financial strategies. You definitely want to stick to those because this is going to be some more noise that's occurring, mainly because our politicians love to fight, and this is going to be on this. We're going to see this because they got to pass a new debt ceiling because we keep spending and we keep pushing to higher and higher levels. So, I actually had from the Raymond James data, I had 3 of these outcomes. You know, potentially the Democrats sweeping both House and Senate, Republicans doing both, and then the split. So this is the Republicans controlling the House, the Democrats controlling the Senate, and some of the market policy implications, kind of the more likely, less likely items. And so, so I'm going to just read through a few of these items here. So more likely, we might have some more regulatory actions because apparently the Senate has more to say on confirmation of regulatory policies. So we might have some more regulatory action. There's already been a lot of regulation under Joe Biden, so that probably is going to continue. I don't know what's on the horizon. Generally, again, you've heard me say this before, like I'm more of a small government, limited government, so I don't love regulations. We're definitely going to start seeing a lot more in the cryptocurrency space because of some of the bankruptcies that we've seen as of late. And so regulations are on the horizon. The next one on here is we probably will have some compromise legislation on antitrust issue, technology issues. You know, there's definitely a lot of bipartisan support for issues around, you know, privacy, around issues of antitrust, especially with dealing with the big tech companies like Apple, like Amazon, like Google, like Facebook, or I guess now Meta. So there's definitely some bipartisan support there. How that's going to manifest itself is unsure. If you remember back, 20 years ago, Microsoft had some of these issues because when these companies get to be too large, they just want to make sure they're not having an adverse impact on competition. And so we're probably going to see more of that. I don't know if that's going to happen before year end, but that will likely be on the horizon over the next 2 years. So again, bipartisan support to putting some restrictions in place, which means that, having some of those restrictions in place will hurt some of those companies. To what magnitude, we don't know, but they're doing it for the better of I guess, long-term growth and competition. So I'm in favor of some of the legislation around making sure things are competitive. I don't like when things get anti-competitive, which oftentimes they tend to do that. So spending is going to remain elevated. We're not seeing that really occur. There's still going to be budget battles. Again, scrutiny on China is going to continue. There are some notes that, the Democrats are clearly not happy with what the Fed chair is doing, Powell. They're not happy with raising rates to this level because they're concerned that it's going to push us into a deeper recession, which obviously is not good politically. So the big issue is we'll likely see is around funding for Ukraine. Are we going to start seeing, is there going to be more support or less support? And it looks like there's going to potentially be less support around that. And then, so those are kind of the more likely scenarios that we're going to see. And then less likely, tax increases, less likely for the next 2 years, expansion of healthcare coverage, and then more climate legislation. Those are things that we're not thinking we're going to see on the horizon. Let me check a question here real quick. Okay. So one of the questions we got is, what is the impact to me if we have a mild, a standard, or a severe recession? So let's talk about that because I think that's a good question. So let me just make sure I close out of this. So the idea of a recession is it really depends where you are in life, right? So if you're in a severe recession, means that there's a lot of job losses. That means asset prices are down. So that's not really great for anybody. Now, I guess presumably if you have a lot of cash and you're an opportunistic investor and you're ready to come in and buy stuff, that's a good thing when things are on sale. But generally, severe recession just means lots of jobs being lost and asset prices, meaning stocks, bonds, real estate, all risk assets, losing value. So severe recession is not great. If we have a mild recession, well, it just depends. What is the mild recession? So when I take somebody who's working, if they continue to work and they have a mild recession, they're not going to be as impacted by it because they're still working, right? And I don't remember what politician had said this, but if you have when you're I think I'm going to butcher this a little bit, but basically along the lines of a recession is when your neighbor is out of work. A depression is when you're out of work. So, for a lot of our working folks, if they're continuing to work, a mild recession means the 401k values are down, their home prices are down. Maybe they'll not get bonuses, they'll get potentially pay cuts. So that could definitely have an individual impact. If you're continuing to working, it's going to have less of an impact. If you're retired, well, retirees, they're living on fixed income, and that means coming from Social Security, from pensions, from dividends, things like that. And obviously, retirees don't like market volatility or recessions because that means their asset prices go down. And so the reality is for most retirees, mild recessions aren't terrible because they're inevitable. Severe recessions are more detrimental because asset prices are going to go down more. So for the reality is, I know who's actually asked me this question. In his scenario, not likely going to have much of an impact because his financial plan is quite healthy. So a lot of it comes back to this whole idea of, well, how healthy is my plan? A big part of what we do and through our financial planning process is that we always like to stress test the portfolio. So, we know when things are going well, when markets are going up, our job is easier because accounts are gaining in value. When markets go down, which again, we know is inevitable, we're going to go through cycles. Portfolio values lose money. That does take a toll on a financial plan, but that's also why we build into our planning is making sure there's contingencies, making sure that we are anticipating some of this stuff. So when it does happen, we can look at the financial plan, assess if it's healthy, and if it's borderline unhealthy, we make adjustments to accommodate for that. So that's why the planning process is so healthy. And as many of you are going to be coming in for either year-end reviews, maybe you've already had them, or once we get into next year, certainly in the first half of next year, we're going to be updating everyone's financial plan to assess, hey, we had a tough year in the markets. What did that actually do to my financial plan? Those are things we're constantly evaluating because we can't control what the markets are doing, but we can control the impact that we make on them, the decisions we make on the investments in terms of rebalancing, reallocating, tax loss harvesting. There's also things you can do as an investor is just depending on how healthy the plan is, you might need to kind of tighten your belt to make sure that you're not overspending. So those are things that we definitely evaluate through these different market conditions. So the reality is when we're in a recessionary environment, if you're retired, the impact on you is the fact that your investment values are down. All right. I just read another question here. So this one might be a little bit harder to answer, but recently read that over 50 counties have gone bankrupt. I don't know if that was counties or countries, but 50 counties that have gone bankrupt. How does that affect the US? I guess that would depend if that's countries or counties. So let's see, it says countries. Clearly, our nation has 30 trillion of debt. The bizarre thing that's happening is our dollar is at an all-time strength. If you guys haven't been paying attention to that, our dollar is in all-time highs relative to the euro, relative to the British pound. I don't know if it's quite at all-time highs against the Japanese yen. I think it might still be, but pretty remarkable. Who would have thought? I studied economics in college. Who would have thought that you have a nation like ours that has basically added $25 trillion of debt over the last 25 years, and that our currency is stronger, right? You would think, hey, if we're adding debt, printing more money, that would actually cause our currency to lose value. So I don't know how that impacts the US. I still think there's a lot of faith in the US system, even in spite of some of our kind of messy policies around spending, borrowing, and printing money. But it hasn't impacted us to this time. But we are getting to a point where at some level, we do need to start dealing with this. And the hardest thing, especially from a political environment, and I guess we are talking about elections. So, one of the things that probably we should start being serious about is, what, maybe we don't have to cut a bunch of stuff, but how about we freeze spending? How about we really identify where we shouldn't be putting more money into? Because just throwing more money at problems, if you haven't really solved the issue, more money doesn't solve the problem. And so that's the reality, is we know we have this growing debt, this growing deficit. And, I do believe that it's important for us to start curbing the increase in debt. But the reality is, that's politicians actually, they tell you they don't like inflation, but they like inflation, because when you have price inflation, what does that mean? That means wages are higher. We're seeing Social Security is higher. And what does that mean? More tax revenue, right? So if on average prices are going up by 8%, and we are taxing goods with sales tax, with income tax, or not goods with income tax, but we're taxing wages, that means more revenue to the local governments. That means more revenue to the federal governments. And so politicians like inflation. They can't really tell you that because it allows them to collect more money. So I don't really know what the impact on countries going bankrupt. I don't really put the U.S. in that bucket. I do think we're quite healthy. We have a lot of assets, even though we owe a lot of money. U.S. has a lot of assets as well. This might be the most painful slide that I have today, so I'm going to go through this pretty quickly as you're going through, and we can provide this slide deck as well. So let me just see if looks like I got a couple more questions coming in. All right, let me just see here. All right, yep, I cleared those out. Okay, we are good to go. All right, so a couple of priorities in the lame duck session. Government funding, we've already talked about that. Aid for Ukraine, Hurricane Ian. So those are going to be some big things as we get into the debt ceiling conversation. We are going to have to pass the National Defense Authorization Act, passed every year, authorize funding levels for the U.S. military and other defense priorities. We know, and you can see this is the first item under here, Senator Joe Manchin is trying to get some energy permitting bills passed. And so because it did not get passed in the September legislation, so I think he's hoping to get something passed. The third one down is one of the ones, I don't want to go off on a soapbox conversation, but if you look at that third one down, it says formal pushback on OPEC, right? So is likely to be at least discussed following the group's decision to slash oil production. So one of the things that gets me either highly confused, sometimes I don't know if annoyed or angry, what the right way of thinking about it, but let's talk a little bit about, as a nation, I think for the most part, we believe in conservation of energy, being smart about energy production, about using energy production, about pollution. Now, clearly not everyone feels that way, but I think generally, especially being here in California, we feel that way. And many Americans, I think, share the idea of conservation as a good thing. Now, what level, everybody has a different opinion on that. One of the things that confuses me is I do know that we as a nation, when we pull oil out of the ground, when we pull natural gas out of the ground, we do it more efficiently than a lot of other, let's call it third world nations or developed nations. We do it more cleanly because we have standards here in the US. So one of the things that really perplexes me, and this is going to get a little political, but it really perplexes me why the Biden administration has been anti more energy, more drilling, more natural gas production here. And what I can't understand about that is if we're producing it here locally, it's good for our job market, it's good for our tax revenue, it's good for our stability from a defense perspective. And additionally, we can control the quality of emissions when we pull it out of our own ground. So the statement that's on here, the formal pushback on OPEC, Biden has been chastising OPEC for not releasing more energy. So it doesn't make sense to me. Like, I get it why we want OPEC to release more energy is because it'll bring oil prices down and it won't cause as much pain for the everyday American. But at the end of the day, the reason why Biden has taken this policy is because of long-term environmental impacts. So it's like, it doesn't make sense to me why that becomes more of a political issue in the short term of solving some of the pain at the pump, but not addressing the real issue about environmental concerns. So this kind of stuff, I think what drives a lot of us nuts about politicians is you're saying one thing and doing another. And the reality is we need strong energy production here in the US to make us less reliant on Russia, less reliant on other parts of the world, the Middle East. And so when you start seeing this kind of rhetoric, it just doesn't make sense to me, and I think a lot of average Americans, because the reality is we need energy to run our country, to fuel the economy, and we should do it more wisely. And so taking a short-term approach and really chastising the Saudis and OPEC around not producing more when he wants it is just kind of crazy, because it does, if you're truly an environmentalist and you're doing this for environmental reasons, it just doesn't add up to me. So I will get off my soapbox. It's about as political as I'll get in the conversation. But it just, let's have some policies that make sense. That doesn't make any sense to me. So we'll likely have we're going to have to pass, the National Defense Authorization Act. Some other priorities, we talked a little bit about it, is the debt ceiling related issues. There's some tax extenders like child tax credits, some other R&D expensing. So there's going to be some things as we get in the lame duck session that they're going to have to do. What that's going to look like, who knows? But they're definitely not closing the door and going home. There's things that have to get done as we go into year end. So these are the big areas that we think we're going to see conflict. Debt ceiling, there's going to be conflict because the Republicans are going to want to create conflict. They're going to want to do it. It's going to be a really good way for them to, to chastise the Democrats for spending too much money. But I think the reality is all of us looking as outsiders, the last 20 years, both parties have been spending way too much money. It's not one party the other. Now, we might disagree on where the money should go, but neither party has shown really any discipline since going back to about 2000 when we had a balanced budget and a surplus. And that was at a time when Clinton and House Republicans worked together to actually balance a budget. Since then, since September 11, 2001, both parties are like, hey, let's just spend money, print money. So this debt ceiling issue, depending on who's in the presidency, this just becomes a way for us to fight. It's going to happen again. Stay tuned. My recommendation is, now that the elections are over, stop watching the nightly news. It's just going to hurt your head. If my mom is watching this, you should stop watching Fox News. Because it's just not good for you. So the debt ceiling is going to be a big issue. Ukraine clearly is. We're going into colder months, which is going to have a bigger impact on basically the lack of energy for Europe and other places, continued conflict in Ukraine, and the funding, right? I think Americans are growing a little tired on continuing just to throw money at this issue. And so who knows what that support's going to look like as we go into year end and start the next year. And then COVID-19, you're definitely trying to, as we're getting through the pandemic, I know everyone has a different opinion on where we are in this, but there's definitely been a push to provide more and more, continue to do more funding to deal with pandemic related issues. And I think the Republicans are rejecting that. So these are going to be like the three hot topics as we go into year end. So I do want to run through just some historical items here and just give you some perspective on the impact, the election impact on markets. So when we look back at the midterm, the third year in a presidential cycle, that going back to 1945, there's not been a recession in the third year of a presidential cycle. So what you can see on the left-hand side, this chart, it actually is showing this dotted yellow area that shows recessionary environment. So the bar charts represent if we had a recessionary environment in year 1, year 2, year 3, year 4, year 5, right, going all the way through year 8, which would mean this would only count when you had a president that served 2 terms. And then it shows, okay, how many have we had, how many recessions, and was there a divided government and was there a unified government? What's pretty fascinating with this chart is out of the 13 recessions, 5 of them happened in the first year, and 3 of them happened in the 4th year. So most of the recessionary environments are occurring at the very beginning of a presidency, or we could say the end of the other presidency, and then going into the 4th year. So it's pretty remarkable to see. Now, most economic experts are predicting we are going to be in a full-blown recession as we go into next year, because of a lot of it is because of what the Fed is doing and pushing the economy into the recession. We will see. Again, I've taken this approach that we went into a recession starting in July of this year, but we're going to be in a mild recession, but a long recession. And what I mean by mild recession is that certain industries are going to still thrive. The oil markets are still doing really well. A lot in technology are still doing really well. So there's certain parts of our economy that are still thriving in this dynamic, but we're going to go through these waves where certain industries are doing great, others are not, and then some of these industries that are not are going to come out and start to grow again. So we're going to see we're going to see choppy results, which basically will mean mild recession, so not massive job losses, but this is likely going to last for a longer period of time. We're not going to see this big bounce back in our estimation. Now, anything can change. If the Federal Reserve decided to pump more money in the system, or if we decided to print more money, those things could be temporarily stimulative. But the reality is it looks like this is inevitable, that we'll be in a recessionary environment. But again, don't let the recession term scare you. A lot of it is the magnitude of the recession. And I do believe, based on a lot of the economic data, that it's going to be a mild one. Now, so just wanted to share that. But these are the kind of the big 5 factors that could push us into recession. This is all data you know. Weakening labor market, consumer spending, continuing tightening from the Fed, reduced government spending, a commodity shock, right, with oil prices being higher, and then continued economic slowdown overseas. So those are some of the big drivers. When we look at equity performance, so while midterm election years are associated with volatility, markets rally following the election. So the charts that we're seeing on the left-hand side, there's a bunch of data points on there, but what's boxed in yellow basically shows what has happened on average following midterm elections in terms of the market's performance. And that blue, the dark blue, represents the average gain, which looks like it's around 12-13%, the 12 months after the election, and what was pretty fascinating on here, and you can see that's right in the middle. 100% of the time, the S&P is positive 12 months following midterm elections. Now, that probably is consistent with the fact that we haven't had a recession in the 3rd year of an election cycle. So that's probably a big driver of that. But I thought it was pretty fascinating that 100% of the time, the S&P has been positive 12 months following midterm elections. And I believe this data goes back about, I don't see it on my disclosure here, but I think it goes back over 60 years. And then I found some interesting charts around, okay, what's the best composition for performance, right? Is it best to have a Democrat president or Republican president? Is it best to have a Democratic, Republican Senate, Democrat Senate? So one of the things when you look at this, what we call the most likely scenarios, which we have boxed here in yellow, it represents an environment that when the Democratic presidents, you can see we're looking at S&P performance by congressional makeup. This is on a historical basis, and you can see that the returns are positive, 12%, kind of in both scenarios. And then basically the long and short of this is the scenario we're looking at right now is a divided government, and you can see returns tend to be higher, at least historically, given a divided government versus unified. So, but you can see on the right-hand side, it kind of contradicts this data. So this is what gets a little tricky when you're starting to look at data. In aggregate, though, divided government sees worse performance. And that a little bit is because we've had some outliers of periods of time. If you look at the far right, there's a 4% column on here. Let's see if I can get my mouse where you can see this. And this happens 30% of the time. A Republican president and Democratic-controlled Congress and Democratic-controlled Senate has resulted in some of the worst performance. And so it shows you that Republican dominated are pretty good. Republican as the president, but in the minority, not very good. And that's what's driving some of this data. But the most likely scenarios tend to be positive for us, which is definitely a good sign. So there's a lot of data on these couple charts that I want to go through, but this just shows a little bit of this dispersion, meaning while politics impacts investment performance, fundamentals are the main driver. So this really looks at like different dispersions of what's happening in the markets. And so we had some periods of time that I will spend some time with. Is you have like Democratic outperformance was during a period for Obama. And this was when we had a unified government. So this is non-divided, unified, which means full control. So Obama had that for 2 years, had really good stock market performance. Now we look at Biden on the far right. He's had unified government for 2 years, poor performance. We look at the bottom, Republican outperformance. I know Eisenhower goes back quite a while, he had 2 years of unified government with really good performance. And you can see Trump's data, 2 years of unified government, historically pretty low at plus 5%. So that just gives you an idea of unified government. Now we go into divided government. So this goes back, what's interesting is looking at a couple different periods of time. So you're seeing Trump on here actually twice. But Democrat outperformance, Clinton, which was a long period of time, about 6 years, where we had a divided government, really strong stock market performance, which was in the late 90s, strong economic expansion. Then you saw Trump's period of time in the second half of his presidency, and that was dealing with a basically Democratic-controlled House. Performance was really good, but then you can see some periods of time, like Nixon Ford is a good example of a Republican president underperformance during a really tough time. That was during the 70s. And so there's no perfect answer on this. I thought it was interesting just to share some of these. But so you still have, while a divided government tends to be better when we have a Democratic president and divided Congress and Senate, the data is still mixed. The dispersion is still mixed. So we don't know exactly what's going to happen. It's a little bit more just fun and FYI, because every period of time is different. There's definitely no set in stone answer of this has to happen. But I thought it was just interesting as I looked through some of this data, just to share it with you, to give you some perspective on some historical periods in the past. We did talk a little bit about debt issues. Debt obviously is a growing concern. So we're going to start on the left-hand side. This shows federal deficit as a percentage of GDP. So this chart does go back to 1940, and it shows, this was really this was at the end of World War II, the early 40s, excuse me. That's when we had massive amount of spending. And then you can see the spending that we had going through the pandemic. We had massive amounts of spending. That's come back pretty quickly. So now we're still running a deficit, but it's shrinking. And then you can see the highest ratio of debt to GDP since World War II. So we have spiked. So these are going to be issues we're going to have to deal with as a country. And I did spend a little bit of time, I guess I could say, on my soapbox discussing a little bit of, we got to start curbing spending, because, this path we can't be on this uncontrollable path of getting out of alignment. And because we're at some of these high levels, you can see what our nation had to do coming out of World War II. We did have to really cut back our spending, and obviously not being in war helped us do that. But you can see then we really brought our debt down pretty dramatically going into the early 70s, and we've been on the climb since. In terms of outlook, pretty much across the board, we are looking at debt to continue to rise. And again, it's pretty much because both parties are okay with debt rising. It's a lot easier for politicians to kind of promise to spend more money, and there hasn't really been enough pushback from voters to push that and to change that. But frankly, I think it's because politicians have apathy around this issue. They might talk about it, but they haven't really made changes. Now, clearly, there's some from both parties that are a little bit more budget hawks, but there hasn't been a massive amount of action from the majority of politicians, because it's hard to take away benefits. It's hard to take away spending. And so it's a difficult task that most people, even you can say Trump was, designed to change, to kind of change how things were done in Washington. And again, at the end of his presidency, dealing with COVID. But the reality is we did not see massive change in our spending policy. If anything, we still continue to have larger and larger deficits through, again, the last 20 years. So this just shows the impacts on the budget. And now, why is this becoming even more of an issue? We have been talking about it for a while, but if you look at the far right-hand side, this is why this is going to become a bigger issue. So we've been in a really low interest rate environment. So politicians have been able to get away with sloppy debt policies because interest is so low. So if you look at the far right, this says net interest outlays will double. So the reality is, our debt has been going up over the last 40 years, but the expense it's been going up forever, but the last 25 years, it's really accelerated. But it hasn't really caused much political harm or economic harm because interest rates are so low. But the simple fact is that the net interest rate was at 1.8%. It's projected to get close, above 3% by 2032. And given the pace we're on right now, that might even go up higher. So that's why it's becoming a bigger issue, because interest rates are higher. which means the cost of servicing debt is going up. Okay, what you've been all waiting for. Let me see here. I think I have a couple questions. Let's see if I can. So let's see. Big question will be winter energy bills on inflation. Electric cars will be more expensive and a bigger drain on our power grid. Okay, so yeah, so there's one of the things, the reality is, as we do go into winter, we're probably going to see prices continue to increase, especially given just the dynamics of, I don't know if the Russia-Ukraine conflict is going to be ending anytime soon. I haven't seen much in the way of headlines that's going to help us with that. But the reality is we do have some challenges, as a lot of it that's local, but there's certainly things that the federal government can do. Is we're going to be moving to a much higher reliance on electric vehicles. That's going to put a lot bigger strain on our electricity grid, and we really haven't geared up for that, and that's going to take a lot of investment. And so in the interim, we're probably going to see higher prices given that. And I could do a whole 30-minute talk on electric vehicles and the impact on, energy policy, the impact on the environment. It's not, I don't have enough time for that because I would probably bore you with too many details, but there's definitely some impact, especially here in California, where we have some pretty, I don't want to say extreme, that's not the right word, but we have some pretty aggressive ideas around going to electric vehicles only. And if you haven't looked into some of the data on the challenges in terms of all the battery technology and all the requirements for batteries and the environmental impact of developing batteries, take a look at it. It's pretty staggering. A lot of the car companies, while they're signing on for a lot of these pledges, really are making the point, and I think Musk did as well, that we're not there yet. And so a lot of these challenges on mandates on pushing through some of these changes, we might not have an economic system or business system set up to be able to handle some of the mandates that are coming through, which when that happens, when you have government involvement, it tends to cause some disruption in pricing, which means that, I guess the long and short of it, from my perspective, is we're probably going to see some higher energy prices, especially for your own home energy bills. Not necessarily gasoline bills, but certainly we're seeing gasoline bills go up. But there's going to be some impact, negative impact on this transformation that we're going to see over the next 5, 10, 15 years, unless we start seeing some really massive amounts of infrastructure spend. So stay tuned. I don't have any real updates. So looking ahead, a preview for the elections. I do think I have a Trump picture on here. I know there's so many people that are not Trump fans. So I apologize ahead of time, but okay. So let's look at some of these after the midterms. So this is where we are as of today. So we have the left-hand side, which is basically the most likely Democratic contender, and then the most likely Republican. So what was pretty fascinating is you can see Biden is still in the lead. That's not the fascinating part, but if you look at a week ago, it was at 31%. It's now at 40%. And I think that was the result of the elections. The fact that there wasn't this big red wave gave more confidence for Biden to run again. And then you could see Gavin Newsom, who is obviously our governor here in California, is polling next. And then on the right-hand side, you can see DeSantis and Trump. It's pretty much a two-man game. If Trump runs, I think he's going to announce tonight whether that's happening or not. I even think, is DeSantis going to run? Does he want to get in the ring with Trump and duke it out with him, or does he just want to enjoy his time in Florida? He's still young. I think I had looked up DeSantis is in his early to mid 40s. So we'll see. At the end of the day, obviously Trump created a lot of noise and a lot of challenges for Republicans because of just his behavior. And so I am personally hoping that he doesn't run, but I don't think he will. I think our country is ready to move on. And me, I'm very pragmatic. I take a very pragmatic approach and like things from both sides of the aisle. And it would be nice to have a government that could actually serve us in that way, because I think most of us as Americans live somewhere in the middle. We're all some version of this middle, but we're governed on the extremes, which is really unfortunate. And that's been the case for 20 plus years. So this is the reality of what we're seeing. This is going to change quite a bit. I mean, we're still 2 years out. A lot's going to happen, but it's not really a surprise. I think here in California, our worst nightmare would be Newsom against Trump. We might have pretty low voter turnout here in California. That happens. I am joking a little bit. Since I can't see faces, since we're on a webinar, I hope I'm not offending anyone, but I do think that for many of us is a scenario we would not like to be put in terms of who we're going to vote for. Okay, so preview for 2024. So again, bottom line, it's too early to tell. And DeSantis looks really good. He looks strong if he is going to run. And you saw those results. There was a lot of confidence coming out of Florida. I don't know if you saw the Florida results, but the reality is he picked up a lot of typical Democrat controlled counties in Florida, which was a surprise. And I think it's a lot of it is because of his policies during COVID in terms of, things that keep the schools open, masking issues, things that, and then you had a lot of, I think, conservatives move to Florida, move to Texas, which also helped those states and helped their I guess, election results. Because of the lack of the red wave, I do think Biden is getting some breathing room on policy. But again, we're still going to be in a pretty divided government. Not a lot is going to happen in my estimation. So again, the announcements are coming soon. So I'll be continuing to read the Wall Street Journal. I won't be finding myself on Fox News or CNN or any much in the way of the media side of things, because it'll just drive me crazy. You have all seen me over the years losing hair. I think that has very little to do with politics because I stay out of the political game. But I think at the end of the day, what we do know is that we find a way to push through in spite of the politicians around us. And while there's not a lot of great choices out there, especially with what we saw in some of the Senate races around the country, Republicans put up some really bad candidates, unfortunately. So hopefully that's a wake-up call and we get better people in government that will represent us and help us move forward, because we have a lot of challenges. I think a lot of companies are going to do our best to solve them, and hopefully we can just let the government get out of the way and actually let people get back to work and have more control and more say in their future. So hopefully this was valuable. Just as a quick, I do enjoy going through the election conversation. It is sometimes hard just because of the political side of things. But hopefully I presented a fair and balanced approach to what the reality is, what we're dealing with. Just as a reminder, we actually do not have a December webinar. It gets pretty close to the holidays, so just happy holidays. We will be doing our annual market and economic update webinar. That will be January 17th, kind of same time, same place. I believe this is going to be something like my 20th year. I don't know exactly, but been doing these for quite a while. And I know we've had a lot of market volatility. So if there are things that are on your mind that you want to reach out to your advisor here at Vance Wealth, please do so. If anyone on here is a guest and doesn't feel confident in their current financial plan, their current investment plan, feel free to schedule a 30-minute consultation with one of our advisors. You can scan the QR code or you can visit Vance Wealth and book an appointment. So thank you as always for your time, and have a wonderful holiday seasons with your family, and I'll see you in the new year.